Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another edition of our Never a Dull Moment Currencies report. I'm joined by Dan Bell from HiFX. Welcome again, Dan.
Thank you.
Look, obviously this week completely dominated by the US Federal Reserve and Chairman Ben Bernanke. He's kept those printing presses running hot.
He has indeed, yeah. So the US Central Bank announced monetary policy yesterday morning. They have decided to print some more money, another $45 billion a month in US Treasury purchases, as well as maintain the existing program around mortgage-backed securities, which is $40 billion a month as well. So QE3 plus or QE4 or QE to infinity, whatever you want to call it, the Fed is still committed to printing money to get this US economy on track.
And obviously he sort of set off a bit of a rocket under the New Zealand dollar.
He did. So the Kiwi US had already been anticipating this announcement. We were trading up towards 84 cents, and we managed to trade to a new 9-month high over 84.5, which is pretty much where we are today, actually. So obviously, printing money is negative for the US dollar and positive, or supposed to be positive for risk assets like the Kiwi. The other interesting thing yesterday is that the Fed have decided to link the outlook to their interest rates to unemployment and inflation, and they've specifically said that they want to see US unemployment under 6.5% before they start removing this additional stimulus. So until we see that, the Fed are going to keep printing, and that means they're going to print and print and print until they get the desired outcome, which is unemployment below 6.5%.
Now, the New Zealand dollar also hit the 80 Australian cent mark too, and the trade-weighted index, it's up around, over 75, up around levels where the Reserve Bank of New Zealand last intervened back in 2007, I think, from memory. Any hope of intervention from this governor?
I very much doubt it. I think the caveat for intervention, I think we have to see a real sustained, almost like a disorderly rally in the New Zealand dollar for the RBNZ to even start thinking about it. Obviously, the New Zealand dollar's been more or less sort of grinding higher against a lot of the majors. I mean, we have had a strong rally against the US dollar. In 3 weeks, we're up over 2.5, almost 3 cents against the US dollar. But it hasn't been a disorderly rally. It's just been happening sort of every day you come in and it's up another 25, 30 basis points. So it's not a disorderly rally. I think if the New Zealand dollar started to gain 1-2% every day for a sustained period, I think the Reserve Bank would start to get concerned. But at this stage, no, I don't think the governor will be intervening. I could be wrong, but whilst the trade-weighted index is at the same level as it was when the Reserve Bank intervened back in 2007, we aren't seeing this disorderly rally in the Kiwi just yet. Now,
there's also some seasonal factors, obviously, that we've touched on before that push the New Zealand dollar higher in December, and then it tends to come back a bit in January. What's all that about? Yeah,
so 9 out of the last 12 Decembers, the New Zealand dollar has rallied, and generally speaking, it's gained over 2%. So, a fairly important sort of seasonal aspect is starting to be created for the Kiwi during December. It's hard to sort of pinpoint it, but I think you get to a point where a lot of sort of hedge funds who tend to sort of trade the currency will start to sort of square up in December, so they're not really as active. I think you're continuing to see the exporters taking cover, which is increasing demand for the New Zealand dollar. I also think there's a case of investors and portfolio managers offshore looking at putting a bit of money on the New Zealand dollar over the summer holidays, our time, or just over the holiday season, picking up the extra yield that we provide compared to most other currencies out there. So that looks like it's at play this month, and it wouldn't surprise us to see the New Zealand dollar remain supported for the next couple of weeks as we get closer to the end of the year.
And looking ahead, this weekend there's elections in Japan with the Liberal Democrat Party expected to be returned to power. Mm-hmm. What sort of impact do you think that might have on events in Japan?
Yeah, so it's pretty much a given that we're going to see a leadership change in Japan, and the new government are expected to be more dovish or more inclined to manipulate their currency, if you like, to weaken the Japanese yen to hopefully make their exporters more competitive. So we are expecting the new government to come out next year with policies around additional stimulus, money printing to try and weaken the Japanese yen. That's already been anticipated. The Japanese yen has been one of the weakest currencies over the last few weeks. The New Zealand dollar has traded over 70 against the Japanese yen, and also against the US dollar it's sitting at about an 8-9 month low. So the Japanese yen is expected to continue to weaken, particularly if you've got a government that is very focused on trying to give their exporters a bit of an edge by weakening the Japanese yen relative to a lot of other currencies. So we should see that by over the weekend.
And next week we've got a couple of pieces of domestic economic data that have been big drivers of the New Zealand dollar in the past in terms of current account figures for November and also GDP for the third quarter. What are we anticipating from these, and what else is out there that people are focusing on, I guess, other than the fiscal cliff?
Yeah, so the GDP figures for the third quarter next Thursday are expected to come in at about 0.5%. So anything weaker than that, I think, will be a bit of a concern. The current account numbers, I mean, we're starting to see a deterioration in New Zealand's current account deficit again, and I think back in the old days, sort of pre-GFC, that used to be quite an important driver of the currency markets. But lately it's all been sort of risk on, risk off, money printing here, money printing there, and the New Zealand dollar has generally sort of benefited from a lot of these global central banks printing money, whilst our central bank has not been printing money, and we've got still quite a low debt to GDP ratio. So it's sort of different times. But I think if you do continue to see a sustained deterioration in our current account, it could be flagged by the credit rating agencies next year, and that's where it could have an impact on the New Zealand dollar. So if someone like Standard & Poor's came out and said, listen, you guys are sucking in too much offshore capital and you're paying too much interest to overseas investors to prop up your property market, then they might talk about downgrading the outlook for our credit rating. So that could be a story that comes about next year. But for now, as we can see, the New Zealand dollar is pretty hot at the moment.
Yeah, and I mean, the markets haven't shown too much concern about the fiscal cliff yet, but obviously that is looming.
It is looming, and listen, I mean, it's a big deal. There is no resolution. Comments from one of the Republicans over the last couple of days indicate that they think that Democrats are going to let the fiscal cliff roll over on the 1st of Jan, so that there isn't going to be a resolution. So over that period, we could see quite a bit of volatility come back into the market, particularly at a time when the market is quite thin. A lot of people are on holiday, so I think we could see a bit of risk aversion in the first week of January. So if they go over the fiscal cliff, there's no resolution. We're going to see this brinkmanship between the Republicans and the Democrats. We know that they don't like each other. They don't like working together. It's going to be extremely negative for the US economy if they don't get it sorted. And I think investors are going to get a little bit impatient, and I think that will be reflected in more volatility. I think you'll see weakness in global stocks and commodities, and ultimately that's going to be negative for the New Zealand dollar, because we will see this flight to safety, which continues to benefit AAA rated assets, most of which are still based in US dollars. So the US dollar could strengthen under that scenario, despite the fact that it's actually the issue has started or coming from the US. So that's definitely something to watch, and I don't think it's really being taken seriously at this stage by markets. It tends to be a case of, for now at least, people seem to be quite comfortable that the global central banks seem to be printing. They continue to, to talk about printing more if they need to, and investors are taking that to mean that, hey, things are okay. Let's just, keep hold of our risk assets. I mean, the S&P 500 stock index is up over 15% this year, so investors have had a pretty good run this year. For now, I suppose they're sort of happy to keep holding on to those assets.
Well, thanks for that, Dan. That's Dan Bell from HiFX, and I'm Gareth Vaughan at interest.co.nz with another edition of our Never a Dull Moment Currencies Report.